Hello, everyone. Welcome back to another Lunch and Learn webinar series. I'm your host, Mayur Thaker. I am an equity strategist here at Zacks Investment Research. And today's presentation is focused on what I believe is what we are underway on in the markets, which is a rotation within the AI trade. Thus far, the trade has been very clear that the semiconductor industry has been the very clear beneficiaries of the AI investment supercycle. But I believe that we are in the midst now, or at least I wanted to present this as an idea, as a thesis, that we are amidst a rotation in the market from the initial beneficiaries of the AI investment supercycle, the semiconductors, and now towards the hyperscalers. And this is my presentation for today, and I'd love to hear your thoughts, and I will share some contact information at the very end. So the core thesis that I want to present here today is that I think that we're rotating now. Cloud and AI platform demand is translating into durable multi-year backlog, recurring revenue, and expanding operating leverage at the hyperscalers. So this is your Amazons, your Microsofts, the Alphabets, and also I would expand this list a little bit to include Oracle as well as a top four or top five hyperscaler. However, these companies have been under pressure in terms of the share price, and I think that this is actually an attractive entry point versus semiconductor names whose earnings are still near peak Capex cycle conditions. So my thesis here today is to be trimming semiconductors, and to be adding the customers of the semiconductors, which are primarily the hyperscalers. This is where I believe that there is relative value in the market, and the risk reward going forward from this point onwards seems to tilt very heavily in favor of the hyperscalers. So what changed, right? We have 515 billion in hyperscaler capex for this year. This is just the sum total of the top five spenders, just five companies. Five companies expected to contribute $500 billion of capex this year. Amazon's AWS order backlog climbed 40% year over year to 244 billion. This improves revenue visibility. Remember, backlog is very important to track just because it tells you a little bit about the forward-looking revenue that you can expect the company to collect over the next year or over the next several years, depending on the guidance that the company gives. But backlog is a very important number to track, and that number has grown significantly for companies like Amazon and Oracle, and others as well. Google Cloud growth, again, 63% growth, incredible growth. So this is why I think the hyperscalers, because of the fact that they're down so much year to date, I think that this is a great time to be scaling into them. These are the companies that have the proven business models and highly recurring revenue, which continue to compound and grow. So the core businesses of the hyperscalers are very much intact. They're very much in a strong growth wave, and yet their shares have been under severe pressure because the market is still a little bit uncertain as to the ROI and the payback period that all of this investment is going to have. At the same time, why am I cautious on semiconductors? Well, because once again, one of the reasons why people are bullish on semiconductors is because they have very reasonable PEs right now. However, I'm here to say that PEs can be misleading at the peak, right? That can be a trap. So when earnings are inflated by a once in a generation capacity and accelerator procurement cycle, the denominator in the PE, which is the earnings, is temporarily overstated. So a stock that trades at 20 times normalized earnings can look like, say, for example, a 12 PE on peak cycle earnings. This apparent cheapness often disappears when orders, utilization, and pricing normalizes. And I believe that that will eventually happen. And we are kind of like at the mid-cycle of the investment cycle. We are midway, but remember, markets look forward. So if we're midway to sort of in the sixth to seventh inning out of nine innings, um, the market does look forward to that ninth inning, and that's the reason why semiconductor PEs have compressed down the way that they have, for many companies like Nvidia and Micron. Nvidia, I believe, trades at roughly a 17 times forward earnings. Micron trades at 6 or 7 times forward earnings. This is very cheap, right? So it looks cheap, but remember, semiconductor PEs are misleading when they are low, right? Because of the fact that semiconductors are deeply cyclical. And so when PEs are low, that's actually the time to be trimming semiconductors. It's a counterintuitive reverse psychology type of a thing. Why? Because earnings at the peak are very high, and that's what makes the PE multiple look very low. But again, when semiconductors are up significantly in price and yet look very cheap on PE, that's actually a signal that we're near the top. Um, Not calling this the exact top, but I believe that the risk reward relative to hyperscalers is very, very attractive and skewed toward, the hyperscalers. Recurring revenue and stable profit growth are improving, right? If you look at the hyperscalers, the top three being Microsoft, Amazon, and Alphabet, um, these are obviously very proven business models. They have very core recurring revenue, strong businesses in the cloud, and very, very deeply embedded businesses that are very profitable and continue to grow on the top and bottom line. And yet have been under pressure for these companies, especially Oracle too. Um, and that's why I think that now is the time where the relative value is very attractive on this level of the AI stack. The build-out phase is maturing into the monetization phase. So remember, in the first phase, the semis led first, accelerators, networking, memory, and foundry capacity captured the initial shockwave of the AI infrastructure demand. This is why NVIDIA and AMD went parabolic, why Micron and SanDisk went parabolic, why Western Digital went parabolic, um, and why the suppliers and the builders, TSMC, Samsung, ASML, and some of the software companies like Broadcom, why these companies went parabolic, right? These were the initial beneficiaries of the build-out phase, but now that these companies have all doubled, tripled, quadrupled, um, and because the buyers, right, meaning the hyperscalers are down so significantly, I believe that, we are now shifting to the next wave of the AI cycle, which is where platforms monetize next. So as clusters come online, workload growth shifts value to cloud rentals, model hosting, software layers, and enterprise AI services, right? These are the services that Google, Microsoft, um, Amazon, and other hyperscalers like Oracle are going to be providing valuable services. So these are the companies that should be monetizing next. And given the fact that their shares are so down and depressed, I believe that this is where the relative value looks most attractive. And so after that is done, the returns will broaden out later to the wider market, the companies that utilize these services to enhance and make their own businesses more and more efficient. But the hyperscalers are the central location where all of these services are going to be utilized by the much, much broader market out there. So pressure on hyperscalers may be an opportunity, not a warning. Capex intensity is enormous, and headline numbers invite fears of lower free cash flow and delayed returns. But I believe that this is actually a bullish, thing because I think that the reason why they're down in the first place is because the market is uncertain as to the payback of all this capex, of these hundreds and hundreds of billions of dollars that are being deployed. But I think what could happen, which is a major upshot, is the announcement by these companies that capex is going to slow. And if they start to announce that, it might take a couple of quarters before we start to see some of that language. But the moment that we see that, the moment we hear Amazon, Microsoft, Alphabet, Oracle take the foot off of the pedal a little bit, not a lot, but a little, we're going to see significant pressure on the semiconductor side of the trade and significant relief rally on the hyperscale side of the trade. Um, and that's another reason why I think the optionality is so much bigger for the hyperscalers. They can always, kind of ease a little bit of the growth in the capex commitment, and that would be very bullish, especially for some of the hardest hit companies like Oracle. I think that would be very, very bullish if they announce that. And I think we're not too far away from hearing the initial reports of that potentially happening. I think we're just a few quarters out from that happening. And I think when that happens, you're going to see massive rebound in these company shares. Hardware cyclicality versus platform durability. That's another big advantage. Remember, semiconductors are very cyclical. The revenue and earnings of semiconductors are almost entirely the capex of the hyperscalers. And capex, by nature, is a cyclical phenomenon. Once the capacity is built, then ongoing spending won't be anywhere close to what they have done these past few years. And so that's why semiconductors are, very risky at this stage of the cycle, because of that deep cyclicality that they will eventually go through. It might still, again, like I said, we do have good clarity on revenue for semiconductors, at least for the next 4 quarters. But again, markets are forward-looking, and it will start to sniff out any slowdown in CapEx deployment, about a year in advance of that actually happening. So cyclicality is a major risk for semiconductors, especially given the fact that these semiconductors have all tripled, quadrupled, or quintupled, over the past year, year and a half. They have moderate earnings visibility, but they do have significant PE trap risk, right? These are companies that now trade at very low PEs. But that is a trap. It's not an indication of value, in my opinion. Hyperscalers, on the other hand, they have recurring revenue, right? Their customers pay subscription fees. So this is very recurring in nature, very predictable, very repeatable, and very sustainable. So very high recurring revenue, which gives them very high profit stability. And they have significant re-rating potential, just given the fact that they've been down so much. Again, I'm thinking Oracle in particular, but all of the hyperscalers, including Meta, for example, um, have very high re-rating potential, given the fact that they're down so much within the context of recurring revenue and profit growth. So again, these are companies that continue to compound revenue and continue to compound earnings at high returns on invested capital, and yet their shares are down significantly because of questions surrounding CapEx ROI. But the moment that they start to announce a slowdown, even if it's gradual, even if it's very slight, the re-rating potential, I think, is going to be significant. So I'm getting very bullish on the next phase of this AI investment, of the AI stack, away from semiconductors and towards the hyperscalers. So what could drive the rotation? Near term, cloud revenue acceleration and margin resilience at the hyperscalers, Microsoft, Alphabet, Amazon, Meta, Oracle. Evidence that the backlog conversion is staying strong despite macro noise. So again, always keep an eye on backlog This is called RPOs. That's revenue performance obligations. Um, this is a very, very important metric that these hyperscalers report, which tells you commitments for services from their customers that the company simply hasn't delivered yet, just because it's in a backlog phase right now. This is important because it gives you an idea, it gives you visibility into revenue into the future, 1 to 3 years out in advance. This is very important. So as the backlog grows, it gives you greater and greater confidence that the earnings and revenue growth that the companies have been delivering thus far can be expected to continue for the foreseeable future. And so when you have greater confidence in future profit growth, combined with a deeply depressed stock price and PE multiple, that gives you a true signal for value. Okay. And then again, signs of semiconductor estimate revisions are flattening as hardware comparisons toughen. These are all signs that could drive the rotation away from the semiconductor trade and toward the hyperscaler trade. Medium term, investor recognition that hyperscalers own the customer, the workload, and the monetization surface, right? They are the centralized location where all of this computing capacity will be put into use through software. And so a moderation in AI infrastructure ordering growth, even if absolute chip demand remains elevated, is another thing to look for. And free cash flow recovery as utilization rises on already built AI capacity. So we should see a recovery, a cyclical recovery in free cash flow as utilization improves, as they slow the Capex spend and profit catches up to all of that Capex which was built up front. So once they start to utilize that capacity, we should start to see significant fixed cost absorption and therefore margin improvement and therefore a cyclical recovery in free cash flow dollars. This is a high conviction bet that I would be making right now in these hyperscalers. However, I do want to present some of the risks. What could invalidate the thesis? Chip demand could stay hotter for longer if the accelerator shortage persists and hyperscaler buildouts extend further than expected, then semiconductors may continue to outperform despite these cyclicality concerns. So that could happen, right? In fact, I do think that chip demand is going to remain, but we are starting to get a little bit of evidence of buyer exhaustion in terms of in terms of the market. We just saw this past week TSMC and ASML report blowout numbers again, but the stocks have sold off because of that. We also saw that happen with Nvidia as well, pretty recently. I think these are sort of the beginning stages of these little hints here and there that the market has largely priced in the steepest and the biggest part of the AI investment super cycle, at least for the next year. But if it starts to accelerate even further, beyond a year, beyond 18 months, at a level even greater than what we saw thus far, then the chip story will stay hot for longer. Another risk to this thesis is that monetization lags CapEx. So if hyperscaler returns disappoint, if the AI adoption ramps more slowly than the infrastructure footprint, it could take longer for these companies to monetize what they have built in these data centers. That's a risk for the hyperscaler side. And then regulatory and competitive pressure, antitrust actions, pricing competition, open source model efficiency gains could compress the expected payoff period for these companies. But I think this risk is mitigated a little bit just you know, uh, because of the proprietary nature of some of these companies like Meta, who has data that nobody else has, through their deep, deep network effects in social media. Same thing with Oracle in enterprise software, since they have the vast majority of Fortune 500 companies as their customers, that is an enormous amount of data that lives in Oracle databases, in Oracle Cloud. Um, so some of these companies have extremely proprietary data sets that are not available elsewhere. And so I don't think that even open source model efficiency gains will really take away from that. So the portfolio implication, I'm here to say that the AI trade is not ending, but it's broadening. So after a massive and likely unsustainable steep semiconductor Capex wave, I believe at this stage, the better risk reward may shift toward hyperscalers with recurring revenue, stable profit growth, and improving monetization of the very infrastructure that they financed. So look at specifically for these companies, the hyperscaler companies that have recurring revenue, stable profit growth, a large and growing backlog, and the companies that have gotten hit the hardest. So I'm thinking, in particular, Meta and Oracle. And it's not just limited to those two, but those are the two big ones that I believe represent a significant value opportunity relative to semiconductors at this stage going forward. So I'd love to hear your thoughts or questions or opinions on this. Please do reach out to us at strategydesk@zackspro.com. If you have any questions, if you have any concerns or any other commentary or feedback, I'd love to hear from you. Again, you can reach us at strategydesk@zackspro.com. And I look forward to hearing from you and to the next presentation as well. Take care, everyone.